Chief Finance as well as Strategy Officer of the company, is joining us currently. Hi, Mihir. Thanks so much for joining in. Let me start by asking you the breakup of the ad growth as well as, in regional as well as national channels, as well as what was the growth X of Ant TV?
Our ad growth has been 29% this quarter versus the same quarter last year. Our full year ad growth has also been in a similar range at 28.9% versus the previous year. Of course, in the quarter, Ant TV had a small impact because it was already in the base when we launched it in the fourth quarter of last year. But if I talk about the full year numbers, if we remove the Ant TV effect, it will clearly be a little lesser than the 29%. But let me focus on the quarter first. So looking at the quarter of 29% growth, I'm very glad to say that while the excluding Ant TV number was not significantly lower than that, even in that number, my regionals and national channels have contributed pretty much at par in terms of the growth. They've all grown at a similar pace to each other. So there's no skew that we see of one category of channels. This is on the back of my regional portfolio doing phenomenally well in terms of market share gains, and the Hindi movie cluster as well as the Hindi GECs gaining significant market share over the last 12 months and the quarter versus the same quarter previous year.
Hi Mihir, afternoon. Let me just stick with the ad revenue growth because at 29%, it's a very big number. It's significantly better than the industry, and it's also coming on a huge base. What's the outlook on the ad revenue growth for the next year?
Sure. So, of course, as I mentioned, the full year growth of 29% advertising revenue includes the Ant TV effect. And that effect we will lose in FY17 because the Ant TV numbers will be in the base. Having said that, our all channels, including Ant TV, have been gaining market share. So if I kind of split it into two parts, one is the market growth itself, which we expect to be around 15-16% in FY17. And that market growth is on the back of the FMCG maintaining a healthy growth, particularly with the likes of Patanjali coming in, and even the other FMCG players not really slowing down a lot. So FMCG, which is the mainstay, continues to have a healthy growth. And then to kind of add a little bit of fuel to the industry growth rate will be auto and the telecom companies with 4G coming in, etc. So we expect the market to be healthy on the back of these industries maintaining the momentum. And the second part is that we are continuing to focus and invest in increasing our viewership share, and which should, all going well, enable us to grow beyond the market growth rates.
Well, Mihir, that's an interesting point you're making, but then how much more than the market can you grow?
Well, that's clearly a function of how well we are able to grow our viewership shares, but we've over the last few couple of years, at least maybe 3-4 years, we've consistently grown viewership share, and therefore that should be a good indicator of what we will attempt to do and hopefully achieve.
Okay, let's talk a bit about the subscription revenue. That was about a 16% growth. What's your outlook for FY17, and what's the update on digitization?
I think the digitization has been going on okay. The other variables in that business, which is the TDSAT order that recently came about, which moved the pricing to a Rio pricing from 1st May onwards, and then the TRAI pricing regulation or guidelines which are being worked upon right now, which may be released in a couple of months from now, are other variables which are the uncertains in this equation. But having said that, we believe that depending on how it pans out, a mid-teens kind of a subscription growth rate for broadcasters should be achievable.
Okay, okay. So could you break that up in terms of domestic as well as international subscription?
So domestic is what I was talking about. International subscription, we expect for us in dollar terms to grow in mid-single digits, and then there could be potentially a currency impact on top of that. So domestic mid-teens, and given that the international contribution, at least in our numbers, is not as high as the domestic, it will not dilute that mid-teens number significantly.
All right, Mihir, let's talk about your margins then. At 27%, it was really a big beat in comparison to any estimates. Could you tell us if these kind of margins, are they sustainable?
So, we delivered a full year margin of 25.8%, and of course for the quarter at 27%. We believe that we believe in profitable growth. So while we will continue to invest in growth in our international markets, like we've been talking about, we will be investing in the digital business. We will be investing in TV and our existing channels. Sports is another property which will have some investment next year, given the India series that are happening in West Indies and Zimbabwe. What we'd like to do is continue to make those investments for growth, but still maintain profitability, and therefore we'd attempt to not dilute the margin. We would attempt to keep it at this level or even grow a little bit.
Okay, so that's the management looking to at least maintain margins at 25.8% in the coming year, despite the increased investments in various businesses. Mihir, could you give us some guidance on the content cost, especially as a percentage of revenue going forward?
So what we believe right now is that the content cost percentage should remain more or less stable, given that the pace at which we are growing revenues will be higher than the inflationary cost, and then on top of that we will have a little bit of increase in number of hours. So let me put it this way: my programming content cost on a per hour basis will grow pretty much inflationary, but we may add more hours to our programming across some channels, and therefore we may have to grow a little faster than inflation at a total absolute programming content cost level. But we would want to let it grow in line with revenues, and therefore the percentage of revenue proportion should not move significantly.
Well, Mihir, the PAT really came in below estimates as effective tax rates were higher. Any particular reason for that? Is it likely to continue?
No, so I would not look at the quarters rate, which indeed have been higher. But if you look at the full year tax rates, they have been pretty much 33-34%. That depends on the mix of the legal entities and the profitability which comes from different parts of our business. I don't expect that to remain at Q4 levels. They should be at full year levels or maybe lower than full year levels as we go ahead in next year.
Okay, is the company planning any new channels? And if yes, what would be the attendant expenses?
So there are no major channel launches planned. Of course, we have some smaller channels, like we may go ahead and launch HD channels for our regional general entertainment channels. We may have a few add-ons like putting up maybe one movie channel in a regional language, but no major new channel launches planned that would have significant impact on the P&L or profitability as such. That it will be kind of low-cost investments in new channels that we may launch next year.
Well, let's talk about expansion then. There are momos on the street. What's your case of being interested in a radio business?
So while we wouldn't want to comment on the murmurs and the speculation that you're talking about, I think from a very, very broad perspective, radio has been something that the group has evaluated at multiple points in time, and that's what it would be at this point in time. I think we've been hearing stuff for periodically every couple of months something or the other comes up, and I don't think we should be reacting to each of those that keep popping up once in a while.
Okay, but do you see any synergies in that business? I mean, radio is a local medium versus TV, which is a national medium.
Well, so we also have, there are two ways to look at it, and I'm purely saying theoretically as a conceptual conversation and not anything to do with our action or our thinking that is being talked about. So theoretically, this radio is another form of entertainment, and therefore it does fit into our offering as such, or any entertainment companies, any entertainment content companies offering. That's one part of it. I think from a local versus national, we have a large regional presence. So in that sense also it's not very disconnected. So yes, theoretically I think it's not very far apart. But like I said, this is a theoretical conversation about what is the synergy that's possible in any such two businesses.
Okay, Mihir, we'll have to leave it at that. Thanks so much for joining in. That's the word from Zee Entertainment. But right now, our colleague Sapna Das is in conversation with Shaktikanta Das.
Has been made.